looking at the implications of interest rate cuts on the stock market. And that has been something we've been talking about for quite some time. The BOJ recently announced that interest rate cuts are on the horizon. I imagine this is welcome news.
It is. It is. Yes, of course, interest rate is so critical to the economy. And sometimes these things happen, and that's when we learn about these, how these variables impact different aspects of the economy and our everyday life. Sometimes we try to tie these things in, and people don't see it, but something happens. Interest rate is really the cost of money. Money is critical, or the movement of money. Money, we refer to it as capital, and it can be in the form of us investors buying shares, ownership in a company, or it can be in the form of us debt. We lending money to these companies, and lending is where interest rate comes in. They must pay us back the principal after a period of time, but also interest in between. Of course, if I'm going to give a company my money, that is buy shares in a particular company, what is the riskiness of that company? What return, if I were to put my money somewhere else, what kind of return would I get? So that's the what you call the opportunity cost of lending the company my money. So the company needs to compensate me for that risk or that alternative option that I have. And in this environment, this is where interest rate comes in. It compensates investors for whatever options they may have that is available to them to put their money in. And so right now it is very expensive, right? It is very expensive primarily because inflation was running, and there are reasons for inflation running. We spoke about COVID and the shutdown of the economy and shortage of supply. We spoke about the whole logistics issue of getting raw materials and moving goods globally. Then we became aware of a conflict between two countries, and we learned then that these two countries are significant and major producers of important global commodities, including food stock. So that added now to the inflationary drive in the global economy. To contain inflation, you have to restrict. People have money, they will run down goods. So you have to restrict the money supply, restrict the ability of persons and companies and entities to spend money to drive inflation further. And so BOJ increases interest rate. That will compel people to invest, compel them to save more, and restrict spending, and therefore pull back on demand somewhat. So it has its ultimate aim is to create a good effect, a long-term effect, a beneficial effect, but it has short-term implication. Because the cost of capital can mean that in the short term, business get crunch. It means in the short term, we have to pay more for everything, right? That's the implication of high interest rate environment. So the market is looking for a reduction in this interest rate, certainly.
But then just when we started anticipating that, boom, here comes Beryl and throwing a wrench in everything. So how is Beryl, or I mean, it already happened,
Beryl,
likely to impact, the reduction in inflation and the subsequent reduction in interest rates that we have been expecting?
Yes. Well, it may throw a spoke in the wheel of BOJ's, intention or to drive inflation down, because that creates two things. It creates a shortage. It creates a shortage in terms of goods and services. Right? It hinders the movement of trafficking, movement of goods, people moving about, transportation and logistics. It impedes, it wiped out several banana farming. It shut down, destroyed some factories, business enterprise, shops. It destroyed people's home, which means that the ability of persons to go about their daily activity and produce is hindered. So it really, I think it exacerbated the problem of the high interest rate environment. BOJ now will have to, alongside other side of the economy, the fiscal side, but particularly BOJ will now have to have a further task of containing whatever fallout that Hurricane Beryl would have caused. That is a shortage of goods, a hike in prices, and we have already seen the hike in prices. So they really have to use special measure to contain that, but at the same time to keep production going. So they will not reduce interest rate. That is not on the agenda in the immediate future, but certainly they have used other monetary policy tool. For example, putting a little bit more liquidity in the system, in order to help producers and businesses to kind of keep the economic wheel grinding. But Hurricane Beryl would have caused a worse problem it would have delayed or perhaps impact the level of decline in interest rate we would have wanted or would have expected if Beryl had not occurred.
So how much do you think this sets us back? Like how much time does it set us back?
Well, BOJ will do their studies, they'll do their analysis, they crunch thousands, tens of thousands of data points. And over a period of time among businesses, right now, they see the effect of inflation. They will look to see where inflation is. And then BOJ, alongside government regulation, the fiscal part may now implement measures to ease the shortage in, for example, food. We have heard just about perhaps a few months ago, pre-Beryl, that some international agreement that we may have to allow the importation of some type of raw vegetable and fruits because of international WTO competition agreements. So that might be put forward on the burner in order to reduce the significant shortage of especially raw food, that is food that is not processed and canned or packaged in any way. We have monetary, and as you know, in terms of managing the money supply, as well as the government fiscal side, using regulations, taxes to drive that part of it, to increase the supply of that, to restrict inflation somewhat. If they are successful in doing that or managing it to some extent, then they had not indicated that by the end of the year they will reduce interest rate, but it may be soon. They may be able to do it, but do it at a lesser rate. They may at least be able to manage. Right now, I think the urgent situation is to contain inflation and to ease the suffering and to get the productive sector as well as people's regular lives moving again. That is critical now.
And people need to temper their expectations as well, because we were coming from record low interest rates, 0.5%. Yes. And then we've gone up to, I don't even know where it is at now, but it's
about 7% base rate. But in the retail, yes, but the productive sector is much higher.
But if our audience recalls, it didn't get to 0.5% overnight,
Exactly.
So a period of quite a few years actually before it came down that much, because every time the BOJ would make an announcement, they would cut another 0.5%, another 0.5%. I think at one point the most aggressive they went was like 1%, 1 percentage point at a time. And so it's not going to go from 7% back down to 0.5 at the next policy announcement.
No, that wouldn't happen. That's too much of a shock to the economy. That would not happen. As well as our domestic economy and monetary policy is also dependent on what happens in the global space, particularly our major trading partner, particularly the United States, which is our major trading partner, yes, where much of our remittance comes from, and much of our trading, tourism, that is our puller, or produces a lot, employs a lot of our people, as well as generates a lot of foreign exchange. So much of our move is really dependent on where that is. If interest rate is high, we don't want to move ahead in lowering interest rate because we don't want capital flight. If interest rate is higher there, remember, note, interestingly, that between 42 and 47% of all savings in the country, every single dollar of any currency saved in this country is US dollars or denominated in a foreign currency. That is people holding US accounts. Yes, GBP, Canadian, yes, right. Wow. So it means that easily people can transfer hard-earned hard currency capital outside of the country if interest rate is favorable in another jurisdiction. So we really have to manage that process. And it's highly unlikely inflation will come back down to the 1 or below 1% anytime soon, in the next year and a half or so. But it will come down sufficiently, though, that we can get the productive gears moving again. Interestingly, I believe even at this rate where it is now, if you look at the performance of the market, several companies are still doing quite well. They are growing. Yes, inflation. Yes, their cost of capital is more expensive, but they are driving business. They are building out facility. They're expanding output. They are employing more people, especially in the retail distributive sector, because where we're coming from 20, 30 years ago, interest rate in the double digits. Even at this stage, there's still the balance sheet, the capital holding of many companies are still fairly sufficient and stable, and sufficient. So they're able to, and even though capital is more expensive, capital is still out there, you can still access capital. So I think that adds some flavor to the economy. So I don't see us moving too quickly. We would not want to. We want to move slowly and steadily and maintain control, but I don't see going back down to where it was in prior periods.
Well, for the past several months, we've been looking to the United States, like you mentioned, to give the signal, looking to the Fed. Should the BOJ just preempt that at this point?
No, we're highly unlikely we will. US is a strong economy. It's the what we should say. There's a term. It's this. Well, I can't remember the particular term, but of last resort. Even when the US economy is doing poorly, investment capital floods to that country, because if the US is not doing well and the global economy is not doing well, people feel safer in an economy that they believe is strong, is sturdy, has good regulatory mechanism, has economy that the support mechanism to spring back the economy. So people are still safe there. So we would not want to preempt them, and drive interest rate up suddenly, spike inflation, especially when we are quite dependent on them. We import a lot of our raw material, even consumer goods, from that country. We would not want to preempt them. We're not in a position really to preempt them.
All right. Thank you so much, Clive, for that take. Always appreciate your input on the program.